Hello, 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 everyone. Welcome to another Tuesday on TFNN. You're listening to the Options Hour with Victor Jones. And over the next hour, we are going to be going over the markets, obviously, and we've got a lot of action today. The S&P 500 now down around 1360, so we've got lots to talk about there. In addition to all of our favorites, which we've been following over, four or five long months, it seems like, for the year. But the market's giving us a lot of action here as we've climbed up steadily to the 1400 area, actually a little bit higher, but really settled down around 1400 until the last couple of trading sessions, and we've broke down to the 1360 area. And you know what, guys? If you've been listening to this show, and we all, we appreciate everyone, whether you're listening on the radio, you're in the Tiger Den, wherever you're listening from, it's not one of those, I told you so days. Because if you always kind of look at the markets or parabolic moves and you see different areas of support and resistance or new highs and new lows, and you kind of put that all in context, you start to see some patterns. And so as we get around highs, we're not always selling, hey, go for broke to go the opposite direction, but hey, a little bit of protection will be smart at these different areas. And if you've been listening over the last 4 months for the year, or if you've been listening even longer, there's 7-8 months that we've been doing, I've been hosting the show, and then Don Kaufman before, you've noticed kind of these patterns of, when we do get to these areas that tend to be, interesting support levels or interesting resistance levels, that the knowledge, or really that the language that we're using, tends to change a little bit. And whether that means, hey, let's dip our toes in here a little bit, and the strategies that we might talk about might be more on the selling put side. And then as we get to the resistance areas, we're talking more about potentially selling upside premium to bring in a little bit of protection, or potentially buying some premium in terms of protecting the portfolio. We're going to get into all that. We're going to get into strategy. As always, you're more than welcome to give us a call throughout the hour show. And last week we had a fantastic show, tons of callers, which we always appreciate. And we were able to go so many different directions, and that's really what this show is all about. So feel free to give us a call at 877-927-6648. I'll say it again for everyone out there. It's 877-927-6648. You're listening to the Options Hour on TFNN. And let's just do a quick market wrap here, everyone, just to give a good idea of what the market is actually doing here. And again, as I said before, 1360 and a half is where we're currently sitting in the S&P 500. And as I quote that, I'm quoting the S&P 500 futures contract. That's the forward month ES. If you're using the ThinkorSwim software, that's /ES, and that's the S&P 500, the June futures contract. Silver here, 31.27 and a half. Actually, that's the first couple of times we've quoted silver. We're going to keep our eyes on it here at this level, and as we go into gold, you'll see why. The Dow here, that's /YM. Again, I'm quoting the futures contract, $12,730 even, down $120 on the day. So, very, very interesting day here. You have the Dow a little bit outperforming the S&P 500, just, by a very, very small margin here. You have the Russell here, 782.90, down 16 points on the day. The NASDAQ, 2,697.5, down 31 points. As always, we want to quote the VIX. And again, guys, if you've been listening to the show, when we sat down around the 15-point level in the VIX, what was our show about? Our show was about ways to put on, it didn't matter if you were bullish or you were bearish, ways to put on strategies that could potentially have, that were biased in the way of long vol. Basically long volatility that the market could see at that time, historically low volatility levels. We could see a nice up move here in terms of volatility, and that's exactly what we've seen as the market's moved off from 15 points in terms of the VIX up to now close to 21. We're at $20.70. I want to quickly note that the market has just lost another 2 points The S&P 500 is now 1358, down 17 points, so a point and a half lower than where we just quoted it. Looks like selling is accelerating. We'll make sure that we continue to talk about it as the show goes on. And as always, we want to always bring it back to what is the dollar doing? /DX, that's $80.17, up 25 cents on the day. To explain what the /DX contract is, again, it's a futures contract that tracks the U.S. dollar against a basket of world securities. So as you tend to hear, how the dollar is doing, you might happen to see it against a particular security, and that may be or a particular currency, and that may be the euro dollar, so on and so forth. There's so many different pairs out there, but really the more important, depending on the companies that you're watching, I think a very important metric is how the dollar is doing versus the entire basket of world securities. Here, the dollar is a bit stronger here today, $80.17, up 25 cents on the day. Gold, $1,640.10, down $3.80. A little bit of a move lower in gold, so you're seeing a move lower in the markets. You're not seeing money move over to the gold side. That could have a little something to do with the dollar getting a little bit stronger here. A looser correlation, but still, in fact, a correlation. Now, crude markets. As always, we've continued to watch these, and it's been a very interesting market. We told you a couple of months ago as we sat around 104, as we hit 105, 108, 110, that these were levels in the crude market that were significantly reflecting the risk premium there in the market, and maybe not necessarily reflecting the fundamentals of the market. But we've continued to watch as crude has moved here, and interestingly enough, as we got around that 110 level, we started talking about and looking at different strategies on that end, and you've seen a significant pullback over the last about 10 trading sessions down to $100.95, down $1.50 today. That's a 1.5%. So clearly today, the market moving off a little bit in terms of not only crude, not only the metals, okay, but also the overall market in general, and you have bonds up just a little bit today. So really a lot of red. I mean, if you were to look at some sort of heat map, really the only thing you would see up here today is those inverse ETFs and the VIX, because that's really what we're seeing here. And so, we're going to keep watching, but there's some interesting levels here, and we want to point them out. As always, after we do our quick market wrap, we want to go into maybe a little bit more of a detailed look at some of these levels. And as you see here, we're coming down right around that 1360 level. I think, as you saw, we really powered through a 1375 level here today. So it was very, very interesting as you kind of looked at that 1375, 1370 area, which could be looked at as an area of potential support. The market has moved down through that level with significant conviction, and I think as you see, that next area, just in terms of simple technical analysis, will be that 1345 level. So it'll be interesting to see really where we end here on the day. But again, selling is accelerating here. We're at 1650 down on the day. So as always, guys, we're going to jump into some very, very interesting securities as we've always been tracking. But we wanted to give you the opportunity to give us a call, and we can talk about not only the overall markets, but we want to talk about underlying securities. If you've got some positions on that you're seeing, the market here is really giving up just a little bit, and whether you think it's a healthy correction or whether you think it could be a start of a new cycle here, it doesn't really matter. I mean, how we play these things or potential positions you're thinking about putting on or thinking about taking off, rolling or rolling up, rolling down, whatever the case is. If you want to talk about position management, you want to talk about some securities, or you think something's getting cheap here as the market sells off 130 points, let's talk about interesting ways to potentially enter those markets or exit. So as always, give us a call at 877-927-6648. Again, guys, that's 877-927-6648. So we've got 10 days to expiration here in April. And as always, we talk about those windows. And those windows of entry and the windows of exits as we talk about, option securities, option strategies, and way that we get into the market as well as ways that we get out of the market. And typically when we talk about option strategies, the entry point that we discuss, in terms of time, is usually 4 to 10 weeks to expiration. I mean, that's something we've talked about on this show continuously, looking at potentially entering trades with 4 to 10 weeks to expiration, at least, and specifically when we're talking about selling premium. Now, what do I mean by selling premium? Well, that means when you're actually, if you own a stock and you want to sell a call against it, that's called a covered call or a buy right. That's selling premium where you're actually selling an option. Maybe you don't own the stock and you sell a put, right? And you sell a put. Well, you're selling to open that position. Now, you can never make more than what you sold it for, but at the same time, in doing so, you're giving yourself, from a mathematical perspective, potentially higher opportunity or higher probabilities of success. So when we talk about 4 to 10 weeks, to expiration, we're talking about, when you're looking to potentially sell premium, when are those windows to do that? Kind of the most effective. When I say most effective, here's what you have to understand about options. Is that, options from a mathematical standpoint, if you were to just look at how they decay over time, because, lots of people, they like to trade. Maybe they like to trade the Jan 13s right now, the Jan 14s, the leaps. But if you look at how an option trades, okay, in the last 30 to 45 days of its lifespan, it's going to lose its extrinsic value the fastest. So if you're selling that option, clearly whenever you sell to open any transaction, you want that to go to zero or as close to it as fast as possible. So if you're looking at options and you're thinking, I'd love to start potentially selling calls against my positions, or I'd love to sell puts to open a position, or whatever it may be, sell, bull call spreads, bull put spreads, bear call spreads, or bear put spreads, iron condors, and all those funny terms that we're talking about here. But if the idea here is to understand how to start utilizing these premium generating strategies, well, then 4 to 10 weeks has got to be something that you remember in terms of opening that position. And to make it really easy in terms of closing rules, if we're opening the transaction with 4 to 10 weeks, we want to be closing that transaction with 4 to 10 days. And why do we say 4 to 10 days? And we're going to bring this home as we talk about a few underlying securities. Apple really moving here today at 635, down 37 cents, and significant volume here. But we're going to talk about it. Now, Now, when we say 4 to 10 days, well, if I'm selling something to open with 4 to 10 weeks, why would I want to close it out 4 to 10 days to expiration? Why wouldn't I want to hold it all the way into expiration? Well, there's several reasons why. If you could remember these 3 reasons, if this is your first time listening or thinking about potentially engaging in some sort of option strategy that is to potentially sell premium. And we'll go over what some of those mean here in just a moment. But essentially, with 4 to 10 days to expiration, well, what happens? As we get closer and closer to expiration, do you think people are going to be opening more positions, or will they tend to be closing a lot of their positions into expiration? And the answer is there aren't going to be too many people out there who are opening these new positions right into expiration. You know, a lot of those things, a lot of that risk is going to be assumed by the market, by market makers. So you'll have less participants here in the marketplace as you approach expiration. Every time you mention the word or the phrase low participants or a lack thereof, essentially what you're telling yourself inherently is that there will be less participants. That means lower liquidity, which means wider spreads. So as you approach expiration with less liquidity, you may have the risk of wider spreads. And what do I mean by wider spreads? Well, let's look at the Apple option chain here, and you can see the at the money option here is $30.15 bid by $30 and 30 cents offered. So there's 15 cents in between the bid and the offer. So there's a 15-cent spread, and as we may approach expiration with less participants, or even as we don't approach expiration, if we just had less people trading Apple, you might see those spreads widen out a little bit. You might see, instead of a 15-cent spread, you might see a 20, 25, 30-cent spread. And what that means is that you may have to work harder for an execution which is, let's say, either at theoretical value or close to the theoretical value of options. So essentially, in order to execute as close to theoretical or fair value of your options, you want to do so at with 4 to 10 days to expiration, and that's assuming value. Some people, though, you may have a position on as we approach expiration, and the market has significantly moved in your direction. Here, Apple is a great case. Who would have thought, at the beginning of April expiration, as you were looking at Apple, and we were trading, just to bring this back, as we were rolling into April expiration, Apple may have been trading somewhere around $570. Is now trading $70, $60 to $70 higher at $636. So the position, if you had sold a put or sold a put spread, both of those are bullish positions, Apple would have moved so far in your favor, you may have some positions on that are essentially or almost worthless. And you're thinking to yourself, with only 10 days to expiration, why don't I just hold on to them? Why don't I just maybe it's worth 5 cents or 10 cents. I should just hold on to these things and potentially make, the 5 or 10 cents or whatever that amount may be. And so the risk here in doing something like that is expressed, I think, in what's happening today. Because the market was at significant or interesting resistance levels, to say the least, at 1,400. And we really had stayed in a very tight range. I know we had moved up just a little bit further than the 1,400 area, but we had really essentially lost a lot of buying pressure at 1,400. If you can remember the momentum with which we moved up to that level, as soon as we got there, the market really lost a little bit of steam. So at the very least, you're looking at a neutral market here with the potential to roll over, which you've seen over the last 5 trading sessions. And so when you see something like that, and you think to yourself, I've got these bullish positions that are almost worth nothing. What's my risk here? So assume you sold an Apple put for, let's say $2. Realistically, it's probably somewhere around, $20, $15, $10, something like that. For easy math, let's just say $2. You sell a put at $2, and Apple moves significantly to the upside. Well, now your put may be worth, let's say, 5 cents. So you're thinking to yourself, well, why don't I just hold on to it and make the extra $5 or $25 or however many you sold? You're thinking to yourself, it's not even worth the commission to close out my position here. I'll be charged more in commission than I will in transaction costs, or on the credit back. And so, while that may be the case at most brokerage firms, at TD Ameritrade and ThinkorSwim, you can actually buy back those nickel options at no charge. And what does that allow you to do? If you sold something for $2 and you're holding on at 5 cents, you think to yourself, what is the risk? Well, I'm trying to make 5 cents. Well, yes, you're trying to make 5 cents, but you're essentially risking the whole $1.95 that you were credited to begin with. So you're saying, to make $5, I'm willing to risk $1.95. And I want you to think back to any situation, whether it be the markets or whether it be any other trading situation, when you thought to yourself, you know what, I'm willing to risk almost $200 to make $5. You start to think to yourself, it doesn't matter if it's options, it's just a general, trading principle altogether. Where does the reward not make as much sense for me to take the risk? And as you approach expiration, that's the general principle, the general idea behind what gamma is. Because you have such a, if you're holding on for an option with 10 cents or 5 cents, the ability for that underlying to move and significantly increase the price of your option increases exponentially as you approach expiration. And so your ability as an options trader to essentially clean up your short option risk is really imperative. Over time, as you're putting on these different positions, you're monitoring the market and rolling up your positions, rolling down your positions, or rolling out, knowing when to do that, and when to really take the risk off the table and know that I've made a significant gain here. It's not worth the risk that I'm leaving on the table to try and make the money that I'd be giving up. So it's a very interesting concept. I think it's a very imperative concept that we understand, and we're going to show a couple of examples here as we look at some of these underlying securities such as Apple, Netflix, Priceline, all these things that are really kind of moving around a little bit today. Before we do so, I want to take the opportunity, we're about halfway through the show, and let everyone know you can always give us a call at 877-927-6648. Again, that's 877-927-6648. As a quick market wrap, 1359.25 is where the S&P 500 is currently trading. We're down $15.75. So at best, the market lost about 17 and a quarter. It's now rallied about $1 to $1.25, but it's still sitting on relative lows for the day at 15.5 to 16 points down, 1359 and a quarter. The Dow Jones, 12,719 points, down 130 points even. So again, as we were watching the Dow, again, we mostly are quoting the S&P 500. That's only because, if you look at what institutional money managers are doing, mutual fund managers, all these different professional or institutional smart money, if you want to call it that, they're following the S&P 500. They're measuring themselves against the S&P 500. So I think it makes sense for us to always have a good concept of what the S&P 500 is doing. The Dow, obviously, a little bit less diversified than the S&P 500, and tends to not always move with the same speed, let's call it, as the S&P 500. So even today, the S&P 500 down about one and maybe 1/5%, a little bit less, and the Dow only down about 1%. So the Dow, again here, $12,719. We're sitting at an interesting support level, at least here, for the Dow. Why do we say that? Well, essentially back in January, as we started the rally, really, for the year, and it really, it started right after January expiration, really. You're seeing a move that really lost a little bit of steam here at the 12,800 level. And if you're watching the chart, I'll point that out for you here. But essentially, right around the 12,800 level, the market stalled a bit before moving higher to 13,000. Before breaking it with conviction, it did again come back and test the 12,800 level. So what you're seeing is, once we came and tested 12,800, the market significantly broke through the 13,000 point resistant area before trading up to as high as 13,245. Now, as the market gives up, again, over the last 6 trading sessions, we've essentially seen red candles over the last 6 trading sessions, including today. We're now, as the S&P 500 broke a significant level, you're also seeing the Dow kind of break that significant level of 12,800, but still there's a little room to play here in terms of the Dow. Especially where we were traced to back in the end of February. So right around 12,750 is really kind of where that level is, which is very close to where we sit today. So it's an interesting support level here. It'll be interesting to see if this is a short-term correction, a healthy correction as we move higher, or if we're going to see a little bit of follow-through here to a level lower than that. And I think where you saw the last bit of really extraordinary buying pressure, at least from price action, was really around the 12,000 to 12,200 levels. So from after that point, you essentially saw a move higher, but a move higher on just more up days than down days. There weren't convincingly large days in terms of Dow price action. Really, as you look back and you say, hey, where did we see some significant movement here? Well, over the last, basically 4 weeks or so, we saw a significant move from about the 12,900 level up to the 13,100 level. We saw a significant move from 13,000, just over 13,000 to 13,200. And then before that, if you can remember, we were down around 1175, 11,750, I should say. And we moved up to above 12,000 in one session. So significant move there. And I think if you were to say, hey, if we're a little weak here, where's the significant or next area of kind of buying support? And that would be right around the 12,200 level. So we're seeing some interesting action in gold here. I'm going to quote this again at 1650 on 30 cents, up about $6.50. You actually saw a little bit of a reversal here in the gold market. So I want to quickly bring it up for everyone to take a quick look at. And we'll go to an intraday chart so we can see some of that price action. So as we started talking about it, we saw obviously that the market was down. The market lost quickly a few more points. The VIX has raised just a little bit here to $20.42, actually down 30 cents in the last time we quoted it. But since then, the dollar broke just a little bit, not as strong, broke about 7 cents, and you've seen gold make a significant move over the last 15 minutes. So basically, we're right around 1640. We've now moved up to 1649 and 70 cents. We're basically on resistance for the day. We made a high about 7:30 a.m. this morning. That's Central Time. And we're making that move. We're now sitting right at intraday resistance. Again, please recognize that that's intraday resistance versus some daily resistance. But again, intraday resistance right here at the 1650 level. We'll see here it's buying just at least in terms of the candle price action is stalling just a little bit, so we'll see what happens here in that gold market. But as we take a longer-term stance or a longer-term look at really what we've been seeing in that gold market, we've seen essentially a move to 1800, down to 1600, and a bounce up to 1650. So what we want to talk about here today, as gold looks to rally over the last 4 days or so, if we were to look at potentially putting on a position, and we can look at the gold futures, or we could look at GLD, which is an ETF that tracks gold or gold bullion. We'll take a look quickly here at what is it that we look at, or what is it that we look at when we're setting up these different positions? And I'll just show quickly. We'll look at 20 different strikes in GLD. GLD trading $160.15, up 78 cents on the day. It tracks really close to 1/10 of /GT or of the futures contract. Not exactly, but very close to 1/10. It's similar to how the spider tracks the S&P 500 futures contract. But as we look at this market here, and if you're using the ThinkorSwim software, I'm just going to show you, if you're in the Tiger Den, how to apply a probability number. As I'm clicking on a column heading on the options chain, I'm going to go down to probability OTM, and that's probability of out of the money. It's essentially the probability that the option expires out of the money. So as we look at these different things, you can think, gold is having at basically that 1650 level a little bit of support here, a little bit of bounce over the last 4 trading sessions. We traded down, if you remember, after the last break, right, very similar to the 1650 level. We had a short-term bounce of 1700. Now we're retesting. We've retested lower. So again, we are making lower lows here in the gold market. So you could definitely say that over the short term, we definitely have a downtrend in terms of gold. So if you're thinking to yourself, hey, we've had some up sessions here where, again, around 1620 to 1650, where could be an interesting entry point? And if it isn't just an entry for gold itself, maybe it's an entry or a hedge to the overall portfolio. And if you were to look at it from this perspective, or a bullish perspective, then how can you utilize options, or what are some ways, obviously, to utilize options to take advantage of that type of strategy? So as we look at the 157, and I'll scroll up so everyone can see what expiration I'm looking at. I'm looking at the May expiration. Of course, I'm looking at May here because there's 38 days to expiration. It's right inside the 30 to 40-day window, 30 to 45-day window, that we quoted earlier. And the 157 option, interestingly enough, has a 62.5% chance of expiring out of the money. Okay, so think about that. If I were to buy the option, to buy that put contract and going down, right? If I were to buy that, there's a 38% chance, 37.5 to be exact, that it expires out of the money. Essentially, that GLD expires above 157 from now until May expiration, the next 38 days. So, if there's a 38 or 37% chance that it expires out of the money from a buyer's perspective, in other words, if I'm buying that put and thinking that we'll move down lower than that, what is the probability that we stay above it? And it's about 62.5%, right? So as a buyer, I have a 38% chance of being in the money. As a seller, I have a 62% chance of being out of the money. So as a seller of that put, of the 157 May GLD put, what I'm essentially saying to myself is that if we stay above the strike price, which is 157, gold GLD is currently trading 160.50. If we stay above 157, I will keep the $2.55 that option is worth today. And really, if you look at your break even, you're going to take in $2.50. So it's not really 157 as your break even. It's 154.50, roughly. 154.50 is your break even. So the current market right now is $160.50. Yet you could get a break even in this strategy of 154.50. So essentially you can make money as long as GLD stays above or $6 higher than what it is today. And for some people, I think that comes as an interesting opportunity, especially if this is your first time looking at either selling puts or selling premium altogether. Because GLD is currently trading at $160. 10% of that is $16, and we've essentially said you could go as low as $6 lower, right? So 3 to 4% lower than really where we are today. So you have a 3 to 4% cushion in GLD in terms of where your actual break even lies. So it's an interesting opportunity here with volatility as well. Volatility here is right at 20%, just under. It's about 19.3% in the month of May. And what that means is volatility is about even with the overall market. So it's not, relatively speaking, it's not more expensive or less expensive to, execute options, sell options in this market than it is in the overall market. So at 150, basically 157, you'll take in $2.55 to do so. So I think it's an interesting opportunity there. As far as a upside move in GLD, as GLD is having a strong, at least last 15 minutes, if not the last 4 trading sessions, if you're potentially looking for some sort of hedge to the portfolio. Now, here's what you have to remember as well. I mean, we've had a significant or 6 down sessions. So I think it's natural in terms of psychology to start thinking, hey, we've had 6 sessions here, downward move. Let me start doing some things to prepare myself for a further downside move, even though, if you think about it as group psychology, if the whole market starts to think that way, hey, let's, maybe it's, I could do something, I could start buying gold, or I could start, as the market starts to think as one, so to speak, you start to see capitulation. That's when you start to see the market, smart money come in and start to buy up some things, and you start to see accumulation build. So the one thing I would challenge everyone is you look at the markets here this morning and you see the S&P down for another 6 sessions, and we're down at this 1360 levels. Pick a point. Pick a point in terms of the markets where you think it's actually interesting, or you think there's a good opportunity to, whether or not you have long positions and you're a long-term trader, or at least an active investor, and you're thinking to yourself, at a certain point, the positions that I already own start to become interesting opportunities here to potentially own more of. And interesting ways to do that are to sell puts, as we've done here. So the example that we gave was a bearish market altogether, bullish gold, but really because this is bullish in underlying security, you can apply this example to other securities in which you're bullish. If this wasn't gold, this was Apple, and I wanted to say to myself, or maybe Apple's a bad example, but some other securities that haven't had a significant run, you're thinking to yourself, basically the market's now trading under or close to my entry price here. At some point it makes sense if I liked it at this price, maybe I like it at that price -3, -5. At that point it's interesting, or it starts to make sense to utilize, short puts as entry strategies, as we just discussed. So we want to go back in, and we'll quickly do a market wrap. We'll remind everyone you're more than welcome to give us a call as we approach the last 18 minutes or so of the show at 877-927-6648. Again, that's 877-927-6648. So as we quickly look at a few different securities, I think that we've had our eye on. We've already talked about Apple. Bank of America is something that we continue to keep an eye on in terms of where it's priced at. And the reason is because at these lower prices and higher volatilities, you tend to get these interesting risk-to-reward scenarios. So we're going to jump into a scenario here on Bank of America, but first we're going to take a call from William in Singapore who has a question on GLD. So we might be jumping back to GLD really quickly. William, you're on the air.
Yes, I am. Hi, Victor, how are you?
Yeah, good to hear from you again, William.
Yes. Victor, I'd like to find out, for ThinkorSwim platforms, is there a way that we can identify, like for instance, gold and Dow Jones Industrial, lately has been moving in the reverse directions. I remember, last year, August, they were moving in the reverse direction, and then after that, I can't remember after how many months, they move in tandem. Now they move in reverse direction. Is there a way that we can use the ThinkorSwim platform to identify this kind of move?
Absolutely. Thanks for the call, William. So as we look at that here, and I'm going to use the S&P 500 here, and I'm going to subtract the price of gold because I think, and I'll use the futures contract because I think they're similar in value here. So let's actually flip that, and we'll do 1360. We'll do gold minus the S&P. So what you're looking at is a chart, basically, of the difference. Okay, looking at a chart of the difference between gold and the S&P 500. And so when you're charting the difference, essentially you're charting the price action, the difference in price action between the two. So as the pair really is what we're looking at right now, as the pair of these two different contracts get wider, essentially they're moving, they could be moving in the same direction, but they're moving at different speeds, and sometimes and oftentimes they may be moving in the opposite directions as well. So as you see that pair get wider, so basically in August of 2011 is where you saw the greatest divergence there. Right. And as we look at gold, we can see why, because you see gold is making that high close to 2000, while the market was making a significant low right around the 1100 level. So as we put those together and we say, okay, what does that mean as I look at gold? We'll type this in here. As I look at gold minus the S&P 500, you're seeing at those areas of greatest divergence, you're seeing those highs being made on this chart if we were to use GC minus ES. And as they start to come in a little bit, or as you see those divergences come together, as we're seeing lately, the market is moving a little bit close together. Now that we're only about 200 points apart, but now we're looking at pure price. We're looking at pure price, not percentage move, or not direction, not moving average. And there are ways to do that, but I think if we were to look at just the most basic answer to your question and what gold was doing basically back in August while what the market was doing in August, we see that significant divergence, and they were moving in opposites, which was when we saw about an 800-point difference between gold and the S&P 500. So it's a great question, William, and I think, just as you said, and as we noticed here this morning, there was a huge divergence. Not a huge divergence. They were moving in tandem, and basically over the last 20 to 25 minutes, we've seen that completely change. Just with a few downticks in the dollar, the gold has now moved to 16.56. It's up $12.14 now. So a significant move to the opposite direction.
Okay, because if we know this, we can actually, like what you just now shown, we can go in on to some of the, GLD options, to take advantage of these moves.
Say it again, William.
Oh, I see. Once we can identify this trend, then we can really take advantage, to like what you described earlier on in the show, that we can take advantage on the GLD options to buy, for instance, the call spreads, to take, to benefit from this, divergence.
Yeah, exactly. And I think so. For all of you out there who are listening, as William brings up a fantastic point. He's talking about pairs trading, and we're saying here that, if it's not, maybe it's a hedge to your portfolio, but why would it be a hedge to your portfolio? We're already long several stocks, so you might look at it as equivalent to being long X many shares of the S&P 500 or X many shares of the SPY. And what are ways then that you could potentially hedge it? So if you're already long the market, how do you potentially, hedge that if you feel that there's going to be a divergence there or an inverse move between the S&P 500 and gold? Well, if you think that the S&P 500 may be going down and you expect gold to be going up as you're seeing on a day like today, well, you're already long the market. Right, so you're long the market. So how do you do that inverse? And so whether you're not long the market, or maybe you're just, as William is looking to potentially do, is actually enter into a pair. Go basically potentially short the market here, but basically long the market and long gold is kind of an inverse, or potentially the opposite. But that type of pair is definitely available, and you can use the underlying security to do it, or you can also use the options market to do it. I think you have to be careful there, and you have to make sure that you're looking at the appropriate deltas for each position. But definitely it's an opportunity. And when we talk about this, but sometimes we're looking at securities that are in the same sector, or in the same industry. Something like an Apple and Google, or an IBM, Microsoft, and you say, I think one is going to outperform the other over the next expiration or the next two expirations. So I'm bringing up something really quickly here, IBM minus Microsoft, and this is just an example here. But as you can see, there's been a significant divergence here in terms of IBM and Microsoft, and there might be an opportunity there to say, okay, I'm going to go long IBM and I'll go short Microsoft. So it's really kind of this inverse opportunity that I'm doing, so that it doesn't matter if both of them move up. Both of them may move down. So essentially I'm hedging the entire industry or the entire sector by saying the direction of that industry or sector does not matter to me. I just want, from a price perspective or percentage price perspective, I want IBM to outperform Microsoft. And whether that means IBM goes up more than Microsoft, or whether it means it goes down less than Microsoft, it doesn't matter. So those are different ways, as William brings up, kind of a more complex or more advanced trading strategy. But as you start to think to yourself, hey, I'd like to participate in this sector industry, I'd like to participate in this one specific underlying, maybe there's opportunities to pair it against a different underlying so that there's a little bit less risk, and that if the overall market as a whole moves back, or the overall sector or industry as a whole pulls back, you still have the opportunity to make money. So I think it's a great question, William, and we appreciate the call as always.
Thank you very much. Thank you, Victor.
Thank you. I think we've got another call from Mike in San Diego, who has a question on iron condors. Mike, you're on the air.
Hello, Victor. I appreciate your program. I think this is very useful for people like us. The question is, I understand how to figure the probability of profit for a vertical, but when you look at the iron condor and you're looking at two different verticals, how does that formula change to determine the profit potential or profit probability?
That's a great question. And Mike, so could I ask, is there any particular underlying that you've been looking at lately or that you're interested in, so that we can cater the example just a little bit?
Sure. We'll just take it real general, like the SPY.
Sure. Perfect. So we're going to pull up the spider here. And first, if you don't mind, Mike, I want to walk through, because I know exactly where your question is, but there may be a lot of listeners out there who don't know the formula that you're referring to. So I want to start there, and we're going to work our way into the full iron condor example, if you don't mind.
Sure.
So the formula that Mike is referring to here, if I were to sell a call spread, for instance, and as always, I'm looking for something potentially with a 62 or around a 62% chance of expiring out of the money. So I'll just look at potentially the 139, 140 call spread. So as I look to sell that vertical spread, we can look at really what it's priced at here. Yeah, I'm getting a little bit closer. Let's go a little bit further out here. Let's go to let's go right to the 1400 level, the 140 level in the spiders, and we'll pull this up. So as I pull this up, the 140, 141 vertical call spread in May, I'm in May now for the spiders, is trading about 36 cents. So it's $1 wide, and it's trading at 36 cents. So essentially what I can do is take $1, subtract the 36 cents, and that will be my real risk in the trade. Theoretically, I should never lose more than $1 because if I'm selling the 140 call, so essentially I have the obligation to sell a stock at 140, but I bought the 141 call behind it, so I always have the right to buy the 141 call behind it. So as long as I don't hold this position, let it expire in between the strikes, as long as I don't do something like that, because a lot of people don't understand that there is risk there. As long as I don't do something like that, I should theoretically only have $1 risk. But because I brought in 36 cents, my real risk here is just, 74 cents or 64 cents? So 64 cents is my risk here. So essentially, to figure out my probability of profit, I take 64 cents, which is my real risk here, and I'm going to divide it by the total risk, or the width of the strikes. So I know that with a probability of profit here for this particular vertical spread, given the current market and current volatility, which essentially is baked into those option prices, is a 64% chance of success or break even. So the question is, if I can do that for a vertical spread, what happens as I start to add on more legs? And so interestingly enough, the prices remain relatively similar. So I'm going to do, since we're at 136, we're 4 strikes up, we'll go 4 strikes down, and I'm going to sell the 132, and I'll buy the 131 behind it. So as we look at it, what is the real risk here? Well, the real risk is still only $1. So even though we have we're short a $1 call spread to the upside, we're short a $1 put to the downside, the market can't be in two places at once. Right, Mike?
Right.
So we know we're only going to lose if we lose on the trade, or if the market does not stay within the ranges that we are designating by doing this type of strategy. We can't lose on both sides. What we could do, is, the market comes up, rallies a little bit, and we get nervous, we buy in the calls, and the market sells off, we get nervous again, and we can lose on the put. So theoretically, depending on how we trade this, we can lose on both the call and put side, but that's only if we don't manage it effectively. But it's impossible essentially for this trade to expire in two places. So my real risk here is only $1, but I've increased the amount of credit because essentially I've sold it at both sides of the market. I've sold both sides. I've sold both the calls and the puts for this effective range. If you're watching in the Tiger Den, I want to show everyone out there what this looks like visually, because I think sometimes we have a better, we tend to look at this better visually than we do otherwise. So we're looking here at, let's go here. We're looking here at our probability of expiring out of the money here. And so you can see we're getting 60 cents in terms of credit, which by our calculation before, right, that leaves us 40 cents of risk. Our probability here in this particular instance will be 40%. So the probability we expire out of the money, or basically outside of the iron condor, is 60%. So I think, the math still works. The math still works. It's just, and it works the exact same way. You still keep the credit that you're receiving, the real risk that you're taking in, and there you're actually getting the probability of you expiring basically inside of your strike. So in this case, there's a 40% chance that we expire inside the strike. So you can see as we kind of bracket that or turn that into an iron condor, in order to keep the same risk to reward, we actually have to, move those strikes out or basically sell lower strike deltas or lower probability of out of the monies. As I do that, I get the combined, as I bring those things back, I get the combined risk to reward that I would have in a single vertical spread. So as I get further and further out, I would work this thing into something like 60 to 65% in order to keep that same comfort level if that's what you were trying to do. But Mike, I took a long-winded way to say it's the exact same math, but I wanted everyone to understand and get on the same page with where you were, but the calculations should still work for you.
Well, okay, so where I'm stuck with is on the put side, you got a 40% with your example, and on the call side, you have a 64% of profit. So how do you combine those to determine the overall probability of profit for that trade?
Great question. So here's what happens. If you could think of it this way, and, if I were to sell the call spread, right, the probability of my profit may be 68%, but that's including every single strike that's below that. Right, and if I'm selling a call and my probability of profit may be 68%, but that's that it goes to anywhere below the call that I'm short or my break even really.
Right.
But in this case, it can't go to anything. It can only stay within a certain range. So I think if you just stick to the same math that you were doing here and saying, okay, what's my total risk, which is $1, and what am I taking in at 60 cents? 40% is the opportunity or my probability of profit, because the market essentially is such an efficient market that it's never going to price anything. It's always going to price based on risk to reward. So if you know your total risk is $1, you're not going to get 40 cents if the probability of success wasn't 60%. The market is always going to price an iron condor or a vertical spread in such a way that the risk matches the reward that you're putting on. So it's difficult to say, okay, this had a 68% chance and this had a 40 and put those together. Just keep using the same math here and saying $1 minus your credit, take that over $1, and that's your profit. So I want to thank Mike for the call. I want to thank William for the call as well, and thank all of you for listening, and we'll continue to monitor the markets, and we'll be here next week at the same place, same time, TFNN and the Options Hour. Thanks, everyone.